What's up everybody, welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony, let's jump in. Okay, happy Tuesday everybody. Shanghai is now in its third week of lockdown, but with the rate of increase of case numbers now slowing, the city may be approaching stabilization, though it is too early to say. While there is some modest loosening of restrictions on some households and compounds in the megacity of 25 million, officially 43% of housing complexes are seeing some easing this week, most households are still in lockdown, and many still have weeks of quarantine ahead of them. A very frustrating state of affairs for those impacted. And we remember that it's not just Shanghai which is experiencing lockdowns and restrictions. Schools have closed in Guangzhou, 18 million people, in Wuhan, 11 million people. Residents need COVID tests to ride the subway, and in the northeast of the country, in Jilin, many are already 6 weeks into quarantine. The large human cost of these lockdowns is very real and difficult to put a value on. But what is a little easier perhaps to put a value on is the also sizable economic cost. I want to show you this graph from Gavical, which the China Focus research firm posted online today. The firm points out that a bottom-up analysis of China's top 100 cities by GDP finds that all but 13 have imposed some form of quarantine restriction, and the intensity is increasing. They classified these cities from no restrictions, level 0, to full lockdown, level 4. It's worth pausing the video for perhaps 20 seconds and examining this graph. It is quite an incredible visualization of just how disruptive Beijing's attempts to achieve a dynamic zero cases policy through highly restrictive measures and lockdowns has become on China's massive economy. We can see here that the thumbnail for this video is talking about varying degrees of lockdown, and we're giving an informed approximation when it comes to the percentage too. The warnings of economists both domestically and overseas are increasingly concerning too. At this point, even an optimistic scenario would be for the restrictions to start to ease towards the end of April. This is very optimistic, which would still mean China's economy will suffer about 2 months of the most widespread and intense lockdowns since the initial outbreak in 2020. And we remember that the 2020 outbreak caused China's first quarterly contraction of the economy in almost 30 years. And only through a massive 30% debt to GDP increase was the government able to kickstart the economy. Indeed, as we know, credit is already being pumped into the economy to stabilize headwinds. At 4.65 trillion RMB, March's increase in total social financing, which is another term for total debt in the system, or non-financial sector debt, came in a lot higher than most analysts were expecting, suggesting that there was a surge in credit creation during the month. As we have discussed in last Saturday's video, however, the government needs to do more than just turn to monetary policy. And they know it. Quote, "No wonder Premier Li sounds increasingly worried about the mounting economic challenges. In the last few days, he has held meetings with local government officials and entrepreneurs and economists. The messaging from both meetings has been similar, that there are greater uncertainties and challenges to stabilize economic performance, and unexpected changes and mounting downward pressure, both domestically and externally, and they need to do more." End quote. State-run Securities Daily reports that Premier Li Keqiang has expressed to officials that they must quote-unquote enhance the sense of urgency to support the economy. If lockdowns continue to persist though, the question will become, will Beijing stick to its 5.5% growth target for this year, or will it let it slide? If it is the former, then it will very likely mean a massive surge in fiscal spending, and like 2020, a huge jump in debt levels. Now quickly, before we move on, state media is now responding to the increased international attention on the situation in Shanghai and the Shanghai lockdowns generally, with a series of English language articles this week seeking to justify the official policy and push back on international criticism. Here is an example of one typical piece. Quote, "Omicron is just a big flu. Experts believe that hyping this falsified notion is a trick used by some in the West to delude the Chinese public and attempt to weaken China's adherence to the zero-COVID strategy, which could easily cause havoc in Chinese society. They believe the dynamic zero-COVID strategy is still best suited to China's situation, and the country will walk out of the pandemic paying a minimal price and sacrifice. End quote. As always, guys, if you're enjoying the content, don't forget to hit the like button. It really helps the channel grow. And for anyone who wants to go the extra mile and help keep the channel sustainable so I can continue to produce these for you guys every day, I have my Patreon and Buy Me a Coffee below. There's also details for those who prefer to send cryptocurrency. If you're watching for the first time and you're enjoying the content, maybe consider subscribing. Hit the bell notification, you'll have the most up-to-date analysis when I release these every day. And as always, guys, just generally, thank you for everyone who's listening. Thank you for the ongoing support. I really do appreciate it. Okay, now let's start with the debt markets and then move to the stock market. Yesterday we discussed that for the first time in almost a decade, on Monday, yesterday, the yield spread between Chinese 10-year bonds and comparable US treasuries turned negative. We said that this development will further fuel the capital outflows that China has seen over the last few months. Let's unpack this some more today. Global funds slashed their holdings of Chinese bonds by the most on record last month as the yield average over the US disappeared. Last month, the premium on Chinese 10-year notes over similar US treasuries plunged to around 8 basis points, down from more than 100 basis points at the beginning of the year. Basis point is a hundredth of a percentage point. Global funds sold almost 90 billion yuan, $14 billion of Chinese sovereign debt in the past 2 months, holding 10% of sovereign bonds as of last month, compared with 11.1% in February. Quote, investors who previously held overweight positions in China onshore bonds due to high carry, a strong currency outlook, and more dovish central bank may continue to scale back exposure to neutral in the near term as the previous advantages fade. End quote. While the outflows are notable, regulators will not be too panicked. There are bigger concerns for the Chinese economy at the moment for regulators at any rate. David Chu, QU, the surname, an analyst at Bloomberg Economics, argued in a report yesterday that if we see a much larger capital flight, the central bank may look at it, but it is unlikely to take any aggressive actions. Domestic analysts also argue that these movements currently still look like short-term fluctuations in capital flows. Indeed, some analysts remain bullish on Chinese assets, arguing that the inflation rate in China is still below that of the United States, and as such, betting that real yields after inflation will still be higher with Chinese returns than US ones. If this is the case, it may come down to how the market values the risk factor in China. Okay, that is debt. Now let's look at the stock market. It is also becoming clear that Beijing policymakers are increasingly concerned about the decline in stock prices over the last 12 months, and especially in the last 30 days. Analysts with Bloomberg's Hong Kong unit report today that, according to sources, market regulators gave window guidance to some big mutual fund houses, telling them to refrain from selling A shares. These are Chinese equivalents of blue chip stocks, I guess, on a net basis on Monday. Yesterday, the verbal request was made to quote-unquote prevent panic selling. Yesterday, the Chinese Security Index 300, a capitalization-weighted stock market index designed to replicate the performance of the top 300 stocks traded on the Shanghai Stock Exchange and the Shenzhen Stock Exchange, dropped over 3%. The CSI 300 is down 17% so far this year, worse than Asian capital markets generally, and much worse than what we've seen in capital markets in North America. This week, the State-Owned Asset Supervision and Administration Commission also published new guidelines for companies to follow in order to, quote-unquote, stabilize investors' confidence and expectations. Directives included encouraging listed companies to buy back shares and major shareholders to hold on to shares. When regulators publish directives like this to stabilize investor confidence, I think many find that it typically has the opposite effect. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.